I love it. Every time I hear the name unFederalReserve, I know it's my company, but I always get that little tinge being in banking for as long as I have. People are like, oh, it's kind of triggering, but it's a great conversation starter. I want to thank the prior speaker, Manuel. It's funny, he showed the abstract for Bitcoin, and I was going to say the two things I carry around in my pocket at all times, besides pictures of my lovely kids, is I carry around Satoshi's abstract, and Constitution of the United States. So it was interesting to see the abstract up there. I want to do everyone a favor who stayed. I'm going to help you pay for this whole conference right now. So we have a live DeFi platform at lending.unfederalreserve.com. If you go to Compound and you have Ethereum, you supply Ethereum, borrow USDC at about 4%, then go to lending at unfederalreserve.com and supply it. We're paying, our community is paying about 25% interest right now on USDC. So if you borrow at 4, or rather you borrow at 4 and then you lend at 20-something, in a couple of months this conference is paid for. You can thank me later. The first thing I'd like to do is dedicate this and all my presentations to this gentleman right here, Terry Wolf. Terry Wolf unfortunately passed away a number of years ago. Never graduated college, no secondary education. The guy lived in a van down in Southern California, taught himself options trading, and actually grew to prominence by inventing the first mortgage-backed securitization that was FICO-based. FICO, Fair Isaac Credit, he actually started, that was used for credit cards. He's the one that said, hey, it works for mortgages too. And just a genius and just an inspiration for me every day. And I'm grateful to have met him. And I'm sorry you all couldn't. He was a little better speaker than I was. So let me give you a little background on our company, and then we'll get right into the discussion about U.S. regulatory compliance and DeFi. Just by a show of hands, does everyone in here own some sort of cryptocurrency? Yeah? Cryptocurrency, you have some? Okay, great. So so that portion, right, about 50% at a conference, probably even less of you are familiar with DeFi. And you hear the term DeFi thrown around a lot. And so what I'm going to try to do in this presentation is I'm going to sort of simplify it as best I can. In essence, DeFi is like we have flea markets in the United States. You have a box of stuff. You go to like an area where there's tables set up. You put your stuff on a table, and then you wait for people to come around and buy it. Well, in DeFi, your box of stuff is your crypto. You put it on your table, and then you walk around the flea market, and if you see stuff on another table that you like, you can borrow it as long as what you're borrowing off that table is not the same, it's less value than what you have on your own table. And as the value of the stuff on your table drops, either due to paying financing charges or the actual value of your stuff drops in price, then you have to pay back your loan. There's a couple of challenges with that. It's very simple right now. There's the terms and conditions are not as robust as regular consumer lending markets. There's just enough information conveyed to one another to provide for a robust lending and borrowing market, but a lot of the features that we'll talk about here in regular lending are not available, and it's a governor on DeFi in general, but it also provides an opportunity for some very simple B2B finance. So we're a fintech. We're seasoned bankers and fintech professionals, and really what we're looking to do is solve the problem with payment cash latency. Here's a great story. I was at HSBC, and I used to sell mortgage pools, all right? So one day, I sold $1 billion pool to Citi Mortgage, and it was like my first big trade. And it was also subprime, which meant the paper was volatile, and we were in that era when things were starting to crack. The cracks were showing. And so I closed this first deal. Like I said, it was around $1 billion. I call the treasury at my bank at HSBC, and I say, Citi is going to wire the money on Thursday. And the nice woman on the other side of the phone said, that's fine, just make sure the wire doesn't come in past 2 o'clock. And I said, past 2 o'clock, why not? She goes, well, if the wire comes in past 2 on Thursday, it won't clear until Monday. And the balance sheet was about $80 billion at the time, so $1 billion actually made a little difference. And she goes, if the wire doesn't clear, they're gonna have to go out into the spot market, borrow that $1 billion, and then they would charge me the interest. So my own treasury in my bank is gonna charge me in a division interest because the wire comes in past 2 o'clock. And I said, don't worry. I'll call my friend over at Citi, and I'll get the wire in before 2 o'clock. And in fact, you know what? Maybe I'll get it in a day early, right? I won't have it come in on Wednesday at all. I'll have it come in on Tuesday. And she goes, no, don't do that. I said, no, don't do that. She said, don't have the wire come in on Tuesday. And I said, why not? She goes, well, if the wire comes in a day early, we've already planned for how much money we need to go to get in the spot market. Your money will be extra money that we didn't have to go borrow. So if your wire shows up early, we're gonna charge you the money that we have to pay to borrow that $1 billion. So I said, okay, no, don't do it before midnight on Wednesday, but not after 2 o'clock. And it was actually kind of funny because that day, the wire had to be signed by the CEO of our division, and he was doing a town hall just like this. And I literally had to interrupt the middle of his town hall to get his wet cig on a piece of paper in order to clear the transaction. And that's real, and it happens. And if that happens at a big bank, you can imagine it happens all over for non-bank lenders. In the United States, the reason why we're called unFederalReserve is not because we're anti-centralized banks, is we're helping non-bank lenders and smaller banks that really do not have access to the Federal Reserve. In the United States, there's 4,000 banks, más y menos, more or less. 10 of the banks control 80% of the assets. 3,990 banks scramble for the remaining 20%, and then behind them are 30,000 non-bank lenders that don't have access to the Federal Reserve, that their sources of liquidity, some of you in here might be representing private lenders or private equity firms or non-bank lenders yourself. What do? You get family office money, you get some PE cash, some high net worth cash, you dip in your own pocket the most expensive kind of money, your equity money, and then maybe you have a line of credit, maybe you have a term loan with a centralized bank, the rainy day. And I'll tell you this much, the term loan or the line of credit that you do have with the one bank you're able to get installed is termed incorrectly. Your lines of credit as a non-bank lender are generally termed for like a 45-day draw, which means you're paying for 45-day money when you may just need the line of credit to cover that 5 days between Thursday at 2 o'clock and Monday when the wire clears. You can use DeFi. You can use DeFi in a whitelisted, KYC'd environment consisting of just non-bank lenders and other institutions and let the unFederal-reserved entities transact with one another. These are some of the entities we work with. E-Residual is our token. It's a governance token, and it's also a digital marker proxy for the licensing fees we charge our host banks that use our software. And these are some of the entities we work with. It's a mix of fintech, it's a mix of traditional finance, and a mix of emerging technologies. I come from banking for 10 years, and then I went into public accounting. So I am probably the most risk-averse person in this space, but I also believe in leveraging what exists. Use the tools that exist. There's a lot of innovation, but I don't know that the innovation needs to necessarily be in reinventing how to borrow and lend. I think it's about bringing all those ideas together to bridge traditional finance and definance. All right, there's a little bit about me. That picture, I love that hat, is taken in Disney World, in the parking at Disney World. And you can't see my little girls on my lap there, and that's why I got a smile that big. But you see my background, HSBC, Wells Fargo, KPMG, handled some large financial transactions for those entities. And let's talk about lending, right? The problem is liquidity, right? You're a non-bank lender, and you want to optimize your liquidity. So a non-bank lender, and just any bank in general, wants to borrow short safe and lend long risky. Okay, let me say that again. If you're a financial institution, you want to borrow short safe, and you want to lend long risky. You make more money when you optimize those two conditions. If you have to violate that, meaning you lend long risky and you misprice how you lend, you suffer losses, and that's no good. If you are trying to borrow short safe and you don't borrow enough to cover what you've lent, you have to go to the spot market. That's expensive. You start crushing that gap. All right, so that's the problem all financial institutions are trying to solve. Borrow short safe, lend long risky. When it comes to the balance sheet of non-bank lenders and other financial institutions, you want security, you want transparency for reporting, and we'll talk about compliance in a sec. I'm watching the countdown. And then, of course, you want speed. The whole idea, the latency that exists, and we've discovered this at unFederalReserve through our conversations with over 200 non-bank lenders in our network. We know the challenge isn't the technology. You'll hear a lot of this. You know, it's not like the servers are a bunch of like 486-33s. I might date myself. That was the first computer I built, using parts from Gateway and a PC magazine. The problem isn't necessarily the speed of the processing itself, but it's all the constant checks and balances that happens through it's decentralized, but it's really just disparate. Not decentralized in the sense of immutable transactions and what have you. The fact is that you have these multiple processes, and interjected in those processes are purposeful manual checks and balances. The system has baked in the need for human eyeballs to sign off on certain parts of the process. And that causes the latency. And that is also the challenge of adoption. When we talk to an institution, you can't talk about the technology. Right? You talk about the fact that, look, if you engage with our Reserve B2B product, your cost of borrowing will be, 50 bips more or less, and your cost of lending, your savings, your deposit return will be like 50 basis points. Your cost of borrowing will be 2 or 3% because all those manual processes are gone. And then they say, well, no, we need the manual processes. That's fine. You need the manual processes. Then, it costs more, the spread widens. Basic components of making a loan: a borrower, a lender, maturity, principal, and coupon. That is all it takes to allow for different companies to balance against one another. Every interest rate you see, every interest rate you experience in life is a function of ability and willingness to pay of a counterparty and the likelihood of default. And in every interest rate you observe, all of these risks need to be accounted for: inflation risk, default risk, reinvestment risk, liquidity risk, some more risks, political risks, economic risks. In the United States, and that's our bailiwick. When it comes to other jurisdictions, people come up to me all the time and they say, hey, does your cash for credit spot market for non-bank lenders work in other countries? I always say it depends. As long as boots on the ground exists that understand local regulatory requirements for banking, and you have a host bank that is comfortable and interested in the technology, it can work. But in the US alone, these are 5. We've counted about 6 government agencies to which we are accountable, or really our software users are accountable, and about 3 others that could probably lay claim to, to be interested in what we have going on. The interesting thing when it comes to regulatory compliance and banking is that the rules, I don't know how many folks in here are attorneys or regulatory compliance attorneys, but when you read proclamations from any of these government agencies, and I'm sure this is a universal truth no matter what country you call you're domiciled in, is that the rules, it's not a punch list. There's no checklist from the OCC, the Office of the Comptroller of the Currency, that sits under the US Treasury, that says, here are the 10 thou shalts, here are the 1,000 thou shalt nots. It's never that easy. what is prescribed by every government agency that we've interfaced with and interacted with are general guidelines for what's expected of you as a handler of information, whether that information is individual information, attributes of a user, institutional information, attributes of the institution that's leveraging your financial rails, and attributes of the currency involved, right? What they say is the regulations really say these are the considerations. You have to collect all this data. You got to keep it private. It has to be made readily available. Oh, and by the way, you have to have a regular reporting schedule. And that's really the extent to which all these regulations describe what you have to do. So what do you do as a financial institution? You bring in compliance consultants that probably came from the agencies themselves or were attorneys working opposite them. Those consultants will write up policies and procedures for your institution that cover what they believe is the breadth of those very generic rules around handling information and how it's transferred and stored. You then hire an auditor, a reputable one, like PwC, if you guys were here for when Henry was talking, right? You hire a reputable firm to independently assess how those rules that you crafted align with these generic rules put together by those agencies. And then you sit back. You turn on the machine. You go about your business, doing what you can to be an honest broker, an honest citizen. And you wait for the door, the knock on the door, for a regulator to come in and say, show me what you've done in terms of regulatory and compliance. And if they're challenging what you've done, really what you need to have at the ready is a stack of papers showing your policy and showing how you followed your own policy. I would say 7 out of 10 times, this is just ballpark, 7 out of 10 times when there's a regulatory compliance issue, it is not an overt violation of a financial services provider that triggered the investigation, but rather inconsistent practices with their own policies and procedures. Most financial institutions that run into trouble when it comes to handling cash of individuals and institutions are they violated their own rules. Maybe the consultant that they hired just copy-pasted something they Googled for AML and KYC, and the operations never matched it. That's the crazy part here. So the adoption of DeFi is not a function of the technology itself impugning the ability for financial institutions to use crypto rails. Their question constantly running through their minds is, if I adopt this technology, will I remain in compliance with the rules I put in place for myself? And then you deal with the institutional challenges of silos and people and fiefdoms inside, right? So with that, old versus new, decentralized is coming. SWIFT isn't a payment system, it's a record-keeping system. And state-by-state rules need to always be considered, and local jurisdictional rules need to be considered as well. When it comes to borrowing and lending, and this is true for, we have the platform I told you, again, if you guys want to cover your trip this week, borrowing USDC on Compound and then staking on our retail site. At the end of the day, you have to consider the riskiness of who the counterparties is, the collateralization, etc. We have a table outside. I have a couple of representatives from my company here. If you want to talk about DeFi in general, or if you're interested, if you're a private equity firm and you're looking for additional sources of liquidity, we have a vault product that allows crypto wealthy individuals to invest in LP interests without having to sell, which is nice. And then, of course, we have our institutional product that's housed within a bank that allows non-bank lenders to cash manage amongst themselves. I want to thank everybody for being here. Please find me on LinkedIn, Howard Krieger. I love to chat. I answer as many DMs as I can. And just everyone have a safe and blessed remaining of your trip. Have a great day.